So today we finally get back to talking about stocks, and today I'm going to talk about a new stock that I have been buying. I started buying this stock around about 2 weeks ago, and today I'll show you the reasons why I'm buying it. Hope you enjoy it. Hit that like button, let's get started. And as always, if you want to know what I'm buying and selling in real time, the place to be is on the Patreon. You get to know my live buy and sell alerts on there, and as well as that you get 2 exclusive videos a week. And if you do want to get some free shares, join Trading 2 with a link in the description. Get a free share worth up to £100. I've noticed a lot of you guys have been using that link recently to join Trading 2. Maybe it's because of all the amazing updates that they have been bringing out. I don't blame you. I personally think it's the best platform out there, especially if you're from the UK. And by the way, we're only around about, I think, 36 subscribers of 15,000 subscribers. So if you could get me there by tomorrow, that'd be absolutely amazing. I know there's going to be a few people watching this video that aren't subscribed, so go do it now. Now, the stock I have been buying is not Netflix. It's not Netflix, but I wanted to use Netflix as a bit of a demonstration before I talk about the stock that I am buying. So Netflix was a stock that had this pandemic pull forward in demand. As a lot of you guys will remember, going back to 2020, the whole CV situation happened. Everyone stayed at home and everyone started using certain companies more than what they would have done, or certain businesses thrived more than what they would have done without the pandemic. And some of these stocks, because they were kind of work at home or something that you would use at home, entertainment for example, it pulled all the demand forward. So people that might have naturally come Netflix subscribers in maybe 2022, 23, 24, 25, they might have come subscribers in that time frame, but because there was all this kind of free time, some of those subscribers came, maybe Netflix subscribers, a little bit earlier than what they should have done. And there was a lot of demand pull forward. And because of that, a company like Netflix, for example, had a big surge in revenue and users, and then eventually the subscribers that they should have maybe got in 2022, for example, didn't join because they had already joined 2 years ago. And that was the pull forward in demand. Now, it has taken around 3 years, but we've seen a company like Netflix finally get over these hard comparisons of all this demand pull forward, and they've gone back to growing. So that's a company that is very similar to this one that I have bought. And an example for Netflix example is if you look at the recent financials, they have really started to improve and they've gone back to growth. Now, the thing is with Netflix is this company trades at 30 times forward earnings now. And this is a company growing at 7% year over year. Great company, but now it's gone back to growth, suddenly it's gone back to a premium. Now, the company that I have been buying is a company that has been similar to Netflix. It's had a lot of demand pull forward. It's in a bit of a competitive space, but the difference is that it's actually doing better numbers than Netflix on a growth point of view, and it's ramping up its profitability as well. But it doesn't trade at 30 times forward earnings. This company actually trades at 13 forward times earnings. So there's a big difference. So without delaying any longer, the stock that I have been buying is Fiverr. So I have started buying some shares into Fiverr. So if you look at Fiverr, you can see the big example here of where the demand was pulled forward and the share price went absolutely crazy. From 2020 up to 2021, this actually came a 10-bagger. Since then, it's given it all the way back and it's now down 91%. Now, I think Fiverr did deserve to have a pullback because these valuations were a little bit crazy for the company, but I think the valuation it has gone to now is looking very attractive from a risk to reward point of view. Now, the share price is currently $27. That does mean it is actually lower than where it was before the whole CV situation and all that demand was pulled forward. And it does actually mean it is lower than where it IPO'd as well in 2019, 4 years ago. Now, sometimes when I use that example, some people will say, but what about outstanding shares? It's okay saying it's lower than that share price. What about outstanding shares? Now, technically, if you do use outstanding shares, there has been a little bit of an increase from the IPO levels, but in the last kind of few years, it has remained pretty stagnant on the outstanding shares. So it is quite a good historic point to actually point out with Fiverr. Now, you'll see here that the company is actually a 1 billion market cap, which does make it a smaller market cap company. And you know me, what am I really bullish on at the moment? The small caps. That's why I've gone and bought the S&P 600 index, because I think there's a lot of value in the small caps, and this is another example of a small cap where I'm seeing value. Now, just to show you why, when you look at the share price point of view, we talked about the stock being lower than IPO levels, being lower than where it was before the CV situation. just look at the difference on where the company is from 2 years ago. So if we actually go on the past performance of the company using Simple Wall Street, if you look at the year ending 2019, the company was doing 107 million. The company now does 353 million. That's a 3.5 times X on the revenue. If you have a look at the company from a profit point of view, they were a company losing 34 million a year. The company is break even at the moment, and in fact, in the last quarter, they actually made profitability, and they're also GAAP profitable now. If you look at the free cash flow, they were a company losing 15 million in free cash flow. The company now does 64 million in free cash flow. So there's certainly been a big improvement from where the company was this share price 3 years ago. Now the platform itself, I'm sure most of you know it, but it's a freelance service. So for example, if I wanted to get someone to maybe help me with my YouTube side of it, and I wanted someone to create YouTube thumbnails, all I would have to do is search YouTube thumbnails on here, and very easy, I can see examples of some of their work. I could see the reviews of the creator. I could see also the price that they would charge for potentially doing these thumbnails. And I think this is a really good platform. I've used it myself, and what I really like about Fiverr is how quick and easy it is to get to someone and get a potential example and the price that it would cost me. So much easier to do this than other platforms. And when you look at the freelance growth industry, I've got an example here from LinkedIn, and they say here, looking in the US alone, there are currently 70 million freelancers, and by 2028 the number will increase to 90 million. That is a whopping 33% of the total US workforce, never mind internationally. And if you look at Google, for example, they employ more freelancers, 54%, than permanent workers, 46%. So this shows you that there's going to be growth in this area, and also major companies are actually going towards freelance workers. Now this is really important because from a freelance worker point of view, people want to work freelance. People want to go, this is the work that I want to take on, this is the price I want to charge, and potentially they can make more money or the same money as working in a permanent role. They get to choose the hours that they work. And then from a company's point of view, so if you take Google's point of view, imagine you have to employ someone 5 days a week. You might not actually need to have them 5 days a week. You might actually be able to have someone in that role for 3 days a week, 3.5 days a week. So from a company's point of view like Google, it's more cost efficient for them to go, rather than employing that person, we save ourselves money and we go get someone from a freelance site and get them to do this work for us. So it works both ways. It works for the freelancers where they get to choose their hour and potentially get more the work they accept and the pay. From an employer's point of view, they save money because potentially someone they don't need it 5 days a week, they get someone in for 3.5 days a week. And you know what? If they really do like them, then they take them on permanently. But it's definitely something that works both for both sides of the party. Now, Fiverr is currently 14% share of the market, and maybe one of the big threats to this is the competition. And currently Fiverr is 14% of the market share. You could say that this is a competitive space, and that's probably one of the biggest threats to it is the competition from the likes of Upwork, for example. At the same time, they've still got a lot of market share to take. You could say potentially there's competition there though, and potentially could that end up with undercutting or people taking market share? It could, but what I would say is that when you are an industry this big, you are going to have competition in the market. I think pretty much you look at every kind of company. McDonald's has competition from Burger King, KFC. You look at Nike, it's got competition from Adidas. Just because a company has competition doesn't mean it's a bad company to invest in. It's just something to be aware of that could maybe impact them going forward. And the attractive thing is from the valuation point of view. Obviously now it is free cash flow positive. So you can see here that it used to trade at like 419 times free cash flow. Realistically now, it's trading around 17 times free cash flow. And if we actually look at the future growth side of it, you can see here that we are forecast to go up to 83 million in free cash flow next year. So that will actually drop to around about 13 times free cash flow if my maths is on point very quickly there. The company as well has been absolutely smashing the recent earnings. If you look here, there's been an absolute beat on the EPS in the last few quarters, which is really nice to see. And when you look at the recent few quarters for Fiverr, you'll be able to see that a year ago the EPS was 0.26. That's now gone to 0.49. And if you look at the next year, we're expecting the EPS to go from 1.89 to 2.23. So the EPS has been ramping up really nice. You look at sales growth, we're expecting 11% next quarter. with the growth really starting to ramp up in the back end of the year, and we're expecting 12% growth in 2024. If you look at the recent quarter, you'll actually see it actually came up 12% year on year, which is higher than what they're actually expecting in Q4, which is really nice to see. And if you look at a revenue point of view, the cost of revenue is only 15 million on a 92 million revenue. So the gross profit this company is throwing off is really, really high. At 77 million gross profit. That's nearly 8% gross profit margins. And when you look at the growth of the company as well, this isn't being funded from sales and marketing. This was always my big worry from Fiverr, is that they only fund the growth through sales and marketing. But if you look at the recent quarter, their sales and marketing actually went from 41 million down to 40 million. So they decreased their sales and marketing, but yet they saw 12% revenue growth, which I thought was very, very good to see. And you can see here they're also managing the costs really well. And that leads the company now pushing towards profitability. And you see from an EPS point of view, they're going to go from a loss of 0.31 to 0.08 in the last quarter, which is really good. And that leaves Fiverr looking at a forward PE ratio of 13 times earnings. Like I said, I think that's really attractive, especially when you look at something maybe like a Netflix, for example, that's doing very similar kind of numbers on a growth point of view. And you would pick Netflix up for 30 times earnings, for example. So this looks like a company to me that has really started to sort itself out from its CV comps, its EPS is ramping up, its free cash flow is ramping up, the growth's coming back to the business. But yet this company hasn't really seen any action. When you look at the share price, it hasn't really joined in the rally this year. In fact, the stock is actually down this year, negative 5%. So it's just totally been ignored by the market, even though the financials are clearly coming back in the business. So you can see why I'm really looking at this company and thinking it's a good opportunity. It's probably also worth pointing out that the co-founder is still the CEO in the company and is the second biggest shareholder, and also that there is other big insider holding inside the company. So I guess what are the negatives with the business? Well, like I said, with the competition, potentially that competition does come into the market and take market share, but I think that is the same with a lot of other companies. The only other two negatives that I do see with the company, obviously you could throw in the word recession potentially, but you could use that for half the companies on the stock market. And in fact, if anything, would companies look to maybe save money and move more towards freelance work to try and save money in the point of view of a recession? Maybe this company would benefit from it, I guess. But apart from, I guess, a recession and competition that are normal negatives you could potentially use with a lot of companies, the financial health wise, I would like a little bit of a stronger balance sheet. They do have a bit of debt on there. You can see they've got 454 million of debt, which is a little high. What does counter that is that they do sit on quite a bit of cash pile, so I can kind of put up with the debt with the amount of cash that they do have. And the other thing as well, like I said, is that they are now going to forecast to move towards profitability, and as well as that they are throwing off good amounts of free cash flow now. So the fact that they are moving towards profit and they will be profitable next year, and the free cash flow they have, and they have a lot of cash, kind of balances out the balance sheet side of it for me, so I don't really worry about that. The only other negative, and maybe it's the reason why it hasn't joined in the rally this year, is that the company is actually based in Israel, as you can see here. So obviously with all the issues that's going on with Israel, potentially that's why people have not been buying Fiverr as much. We've seen the impact that caused for other stocks like InMode, for example. So maybe that's what's held it back this year. But overall, I don't think that will be much of an issue in the longer term. So yeah, overall, you can see the reasons why I do like it. You can maybe see a couple of negatives on why it's maybe being held back, but overall, I think the risk to reward here does look pretty attractive. So I did buy some shares in Fiverr. Now, I bought a stake in Fiverr around about $27. I would probably buy some more at $25, and then I'll probably have a third buy at around $23. So I would plan to buy every 10% drop. If it does go below $23, so if we did see it hit around $21, I potentially could have one more buy left in me by that point of view. I mean, after that, if it was to go to $19, I'll then have to consider that it would be getting a large position. But then when I start working out, if it was $19 at the time, I think the valuation may push me to buy even more if it was to go to $19. But I think the valuation is already quite attractive here. So yeah, I did buy a stake in here, and we'll see what happens here. But right now, when I look at the valuation, the risk to reward, the growth that they're starting to put back into the company, I think this is definitely an attractive one to pick up right now. So I did buy some more shares in Fiverr. Hope you enjoyed the video. Let me know what you think of Fiverr in the comment section. Hit that like button if you're not here, subscribe, and I'll see you in a bit.